Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jiangsu Lopal Tech, Group Co. Limited, annual report. And Jiangsu Lopal Tech, Group Co. Limited, offers a diverse range of products and services that cater to various industries. The company's primary focus lies in the production and sale of lithium iron phosphate cathode materials and environmental protection fine chemicals for vehicles. The company provides a variety of automotive-related products, including lubricants, grease, coolants, brake fluids, and chemicals. These products are essential for maintaining vehicle performance and longevity. Additionally, Jiangsu Lopal Tech, Group Co. Limited, offers industrial lubricating grease, which is used in various manufacturing processes to reduce friction and wear on equipment. The company also provides automotive maintenance products, such as lithium battery materials, hydrogen energy solutions, and plastic new materials. These innovative products are designed to enhance vehicle efficiency, safety, and sustainability. Jiangsu Lopal Tech, Group Co. Limited's product offerings are sold under the Longpan brand name, which is recognized for its quality and reliability. Overall, Jiangsu Lopal Tech, Group Co. Limited, has established itself as a leading provider of specialized products and services in the automotive and industrial sectors. Jiangsu Lopal Tech, Group Co. Limited, market capitalization of 19 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Jiangsu Lopal Tech, Group Co. Limited, holds a significant advantage in their industry. Jiangsu Lopal Tech, Group Co. Limited, trades at a higher price-to-book ratio of 2.36 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost, and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the increase in revenue from lithium carbonate processing is a significant contributor, with a staggering 722.3% rise. Additionally, sales of LFP cathode materials and automotive specialty chemicals have also seen substantial growth, with increases of $577 million and $135 million respectively. Robust industry demand, continuous technological iteration, strong government support, and the launch of new products have all contributed to this revenue growth. Furthermore, the growing demand for LFP cathode materials in electric vehicle and energy storage markets has led to a 10.3% increase in sales. The boom in the new energy vehicle market and supply partnerships with leading manufacturers have also driven up revenue from automotive specialty chemicals by 7.4%. Finally, the expansion of business operations, introduction of in-house mining operations, and growth in production and sales volumes for processing income from lithium carbonate have all contributed to this significant increase. On the other hand, the primary drivers of revenue decline are largely related to increased costs. The cost of sales has risen by 8.7%, with selling and distribution expenses increasing by RMB 12,193 and finance costs rising by RMB 40,289. These increases in costs have had a negative impact on revenue, contributing to a decline. The net income and profit margins of the company experienced significant changes between 2024 and 2025. The net income increased by a substantial 700 and 22.3% to RMB 575.6 million, and further rose by 127.8% to RMB 1,135.6 million in 2025. This remarkable growth can be attributed to various factors. One of the primary reasons for this increase is the significant improvement in profit margins of cathode materials, which rose from a mere 0.01% in 2024 to 8.1% in 2025. Excluding inventory impairment, the profit margin increased even further to 9.1%. The automotive specialty chemicals business also saw a slight increase in gross profit margin from 27.8% to 28.6%, while lithium carbonate processing services experienced an increase in gross profit margin to 15.8%. The reasons behind this change are multifaceted. Firstly, the company's sales of cathode materials increased significantly, contributing to the growth in net income and profit margins. Additionally, the decline in price of major raw material, lithium carbonate, helped reduce costs and boost profitability. Furthermore, the increase in proportion of sales with procurement from customers also played a crucial role in improving profit margins. The fall in prices of certain raw materials and the rise in sales of new coolant products were other contributing factors to this growth. The company's financial performance suggests a mixed picture regarding its operating cash flow. At first glance, it appears that the company is generating a negative operating cash flow of RMB- 1,222 million, as stated on page 6. However, this initial assessment seems to be contradicted by further information provided on page 38. Upon closer examination, it becomes clear that the company's ability to make debt repayment indicates a positive operating cash flow. This suggests that despite the negative value of RMB- 1,222 million mentioned earlier, the company is actually generating sufficient cash to cover its financial obligations. Therefore, based on this analysis, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes. The total debt has increased by a substantial 24.6%, rising from RMB 8,632,620 to RMB 10,824,743. This increase is also reflected in the total liabilities, which have risen from RMB 12,032.2 million to RMB 14,894.6 million. However, despite the rise in debt levels, interest expenses on bank and other borrowings have actually decreased by RMB 22,976, falling from RMB 252,252 to RMB 229,276. Furthermore, interest payable has seen a notable decline of 44%, dropping from RMB 06744 to RMB 03762. These decreases suggest that the company may be benefiting from more favorable interest rates or terms on its borrowings. The performance of various segments and regions in the industry has been mixed. On a positive note, Customer A has shown strong results, as have sales of LFP cathode materials segment. The Chinese mainland regions have also performed well, driven by growth in the LFP automotive for lithium cathode material business. Additionally, the specialty chemicals and raw materials business has seen success. However, some segments and regions have struggled. Customers B and C have underperformed, while the processing segment and specialty cathode material have faced challenges. The carbonate and raw materials business has also experienced difficulties, indicating areas that require improvement. Management is optimistic about the company's future prospects. They are confident that there will be no additional liabilities resulting from a lawsuit, which alleviates concerns about potential financial burdens. In terms of strategy, management plans to increase its shareholding ratio in Changzhou Liyuan to 66.42% after a capital increase. This move is expected to provide greater control and influence over the company's operations. Looking ahead, management intends to focus on business development by identifying new opportunities for growth. They also aim to optimize resource utilization and generate more income from idle funds. Furthermore, they will be investing in the Jintan project, which is expected to enhance operational efficiency. Overall, these initiatives demonstrate a commitment to driving growth and improving performance. The company has made significant investments through acquisitions to expand its operations and capabilities. One notable acquisition is the commencement of a 90,000-ton LFP cathode materials project in Indonesia, which involves an investment of approximately RMB 324 million. This move demonstrates the company's commitment to growth and diversification. In terms of divestitures, there are no mentions of any such transactions in the provided summary. The company appears to be focused on acquiring new assets and projects rather than selling off existing ones. The company's financial strategy has been focused on retaining earnings rather than distributing them to shareholders. According to the provided information, the company has chosen not to pay dividends, indicating that it prefers to reinvest its profits within the business. Furthermore, there is no indication of any share buyback activities, suggesting that the company is prioritizing growth and expansion over returning value to investors through this means. Concerns have been raised regarding inventory buildup, a pressing issue that warrants attention. According to the report, this concern is explicitly stated on page 26, highlighting its significance. The accumulation of excess inventory can lead to wasted resources and inefficient use of storage space, ultimately affecting overall operational efficiency. The potential for supply chain disruption also looms large in this context. Inventory buildup can strain relationships with suppliers, leading to delays or even complete disruptions in the supply chain. This, in turn, can have far-reaching consequences, including lost revenue and damage to a company's reputation. That concludes the financial summary for Jiangsu Lopal Tech, Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.